Yeah, so I think probably the market's getting a little nervous right now with all the volatility we've seen. So it may be non-consensus that we are adding risk amid this volatility. So our multi-asset portfolios are overweight risk, both in equities and in credit. Probably the more non-consensus view is our overweight in credit. As everyone knows, spreads in investment grade corporates, in high yield, in emerging markets debt, we are at really tight levels of spreads. If you only looked at valuations, that would be reason enough to say we are not overweight, we're underweight. But we have a particular insight about spreads. We have seen in past periods of tight spreads, like in 95 to 97, 1995 to 1997, and 2004 to 2006, that spreads can stay tight for years. And in 2004 to 06 and 95 to 97, there were 2 to 3 years that spread stayed very tight. So I'm not saying that we're going to see spread tightening from here, but I think it's an excellent carry environment. What I mean by that is you're collecting coupon. Remember, 100 basis points spread in corporate bonds over 4.5% treasuries is a 5.5% yield. That is a very attractive yield that compounds over 5 to 10 years. And by the way, because yields have gone up, the duration of the corporate bond market has come down 2 years, from 8 years to 6 years. So you're getting more yield and less duration risk. So we like the environment for credit risk, and I would say that's probably our biggest non-consensus view. The other area, I'll just mention a couple of relative value trades. In the government bond markets, we think that central banks are actually a little divergent. So this is a really interesting time for the Federal Reserve and the European Central Bank. Europe, as you know, is very weak right now. It looks like they're starting to inflect up in terms of growth, but they're starting from zero growth, essentially. And they were teetering on recession all of last year. So we think that the ECB is going to cut rates before the Fed. And therefore, in our portfolios, we're long European rates and short US rates. So that's one interesting trade. And then we like European credit more than US credit. There's a little bit more spread, and so we think you can pick up some extra yield and some spread tightening in the European markets. We, as you know, we've been long Japan for the past year now, and Japan has outperformed all markets, both in local currency and dollar-denominated terms. So we may take some profits there, we'll see, but that has really been a great position, and I'm still recommending Japan. And then we moved to neutral. We were underweight US, and we're now neutral US. But the big theme is that we see the rally broadening from a narrow set of US mega-cap tech stocks to value-oriented stocks. And when I say value, I mean a big umbrella around value, not just energy and financials. I'm talking about international, I'm talking about value, the traditional value, and even maybe small cap. So I think that those are areas that this rally will broaden out to. And in fixed income, as I said, we're looking at 4.5% 10-year yields. I think somewhere between 4.5% and 5% is fair value for the 10-year. And then if you can get an extra 100, 200 basis points, you're looking at really attractive yields.